Okay, I think we'll get started here. I know people are still gathering, but we have a few things to get through beforehand. So again, thank you all for joining us this morning, almost afternoon for some of you. We are going to be discussing Capital Markets 2021, COVID impact and outlook. Thank you for joining us. If you joined us yesterday, we appreciate you being with us again. If you are participating in the Deal Connect meetings after, we're looking forward to that as well. But we're going to discuss capital markets first. For those of you I have not yet met, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We are a lower middle and middle market M&A focused organization. So we now have one national community. We've made some changes since COVID in 2020, but we've combined all of our chapters into one national community. We're doing a lot of new event formats, fireside chats, roundtables, of course, our Deal Connect meetings. We've introduced Opus Mind. We have a lot of webinars coming up. Lunch for Six is a new initiative that Lou is spearheading. So if you want to learn a little bit more about us, what we do, how we can help, please reach out to my colleague, Jacob Zephyrin. He'll be happy to answer any questions. Today, our panel will take as many questions as possible. So as they come to mind, please feel free to submit your questions in the Q&A bubble below. I would ask that you please refrain from using the chat box and keep your questions strictly to the Q&A bubble. It'll be easier for us to monitor. And again, we'll try to get to as many as possible. I do want to take a moment to allow our sponsors to say a few words. David Kogan, longtime supporter and friend of Opus Connect. David, please introduce yourself and your firm.
Good morning, Lena. Hi, this is David Kogan. I'm the Managing Director of Sapient Investigations. We're an international corporate intelligence firm. And as Lena said, we've been sponsoring Opus now for over 10 years. We specialize, we're basically for the private equity and lending world, we are an executive background investigations company. And we look at both management teams, business partners, joint venture partners, obviously large commercial borrowers. We also look at companies themselves, and that's often helpful in these situations. We also have a robust business dispute division, and we do a lot of work on litigation and fraud, if that ever comes into play. And as always, it's great to be here and look forward to meeting everybody.
Thank you, David. And next, we have Comvest Credit Partners, but Dan Lee is going to be speaking on today's panel. So we're going to wait until we introduce the panel before he introduces himself. And before we begin, we have two poll questions we'd like to ask. So please go ahead and submit your answers. I'm going to launch the first question. We'd like to know who you are. So give us a good idea of who's in the audience, independent sponsor, investment banker, etc. Let us know. We'll give it 30 seconds and we'll move to the next. I'm sure many of you in here are participating in our first event of its kind. We're doing a Deal Connect around lenders, pairing up non-bank lenders and bank lenders for one-on-one meetings. So I expect a few of you to be in here, but let's see how it goes. Don't be shy. We'll give it 10 seconds and we'll move on. Okay, interesting. 8% investment bankers, 0% capital providers on the equity side, 21% bank lenders, and 21% non-bank lenders, interesting, and 50% other. Okay, thank you for participating in that. We have one more question I'd like to ask, and that is around in-person events. When are you comfortable? Now? Never? You want the vaccine first? Let us know. Of course, Opus is doing all of our events virtually for now, but we'd like to see where your level of comfort lies. Great, thank you. So not too shocking here, 25% already now. Majority of you, 67%, not until you get the vaccine. and 8% are good just where you are from the comfort of your home, doing it virtually. Thank you for participating in that. And without further ado, I'd like to introduce today's moderator, Ioana Barza from Refinitiv. Ioana, the floor is yours. Take it away.
Thank you so much, Lena. And thank you to Opus Connect for creating this fantastic event. And Dan, thank you for your sponsorship, time, and effort in gathering this group. On behalf of all of us on this panel, I want to thank all of you for joining us for this session. We're all really looking forward to providing you with our insights and the trends that we're going to be watching this year. So my name is Ioana Barza. I run analysis at Refinitiv LPC. Now, some of you might be familiar with our Gold Sheets publication. We've been covering the loan market since the 80s. But today you can find us on Twitter at LPC Loans, very easy. We host loan events, everything virtual this year too. And we have a platform that includes a searchable comps database on loans globally, dedicated news reporters and analysts like myself. If you haven't seen any of our reports, please contact us. Or if you haven't subscribed to any of our middle market and direct lending reports, you have probably seen them cited. Similarly, the folks on this panel wear many hats, and they see the market from so many different vantage points. So let's start the Dan, Fran, Rand show. It has become somewhat of a tradition in the market, and I am probably more the Seth Meyers here than the James Corden. But now I want to move on to the rest of the panel and ask you all to introduce yourselves. And as we said, Dan, let's start with you, and thank you again for sponsoring this event.
Yeah, my pleasure. I am really excited to do this, and I'm glad that I was able to latch on to the Fran and Rand show, which is, if you haven't seen it, I would suggest you check it out. Two of the best providers of market color out there. I am Dan Lee. I am with Comvest Partners. We are a private equity firm based in West Palm Beach. We've got a private equity control strategy with about $1 billion under management, and our lending fund where I sit has about $3 billion under management. Typically looking to invest in companies with a minimum EBITDA of $6 million and above. Super excited for the conversation.
Hey,
Fran.
everyone. Yeah, hi. Hey, I'm Fran Beyers. I am the head of capital markets in the private debt group at Cliffwater, which I just joined about 3 months ago. Cliffwater is an alternatives consulting and asset management firm. We advise on over 77 billion in assets across a full range of investments, but we are very focused on private credit. And we also have 3 billion in assets under management. Just prior to joining Cliffwater, I too worked at Refinitiv LPC with Ioana for over a decade. I was the head of middle market analysis, and I provided research on both the syndicated and direct lending markets. I'm really excited to be here today. So thank you to Dan and Opus Connect for having me.
Good morning, good afternoon, good evening, wherever you're listening from. Randy Schwimmer. It's so great to be here, reunited with Fran and Dan, who's the latest member of the band. It's great to have you. Thanks to Opus for putting this all together. Randy Schwimmer, head of origination and capital markets at Churchill Asset Management. We're a direct lender, an affiliate of Nuveen, which is, depending on where the market is today, $1 trillion asset manager. We, as Churchill, have probably about 30 billion of capital at work, and we are up and down the capital structure, primarily in the middle market, and focused for the most part on private equity sponsor-backed companies. So it's great to be with you. I also publish a weekly newsletter called The Lead Left. That's where Fran and I sometimes hold forth. And if you shoot me an email, you can shoot me either at randyschwimmer@churchillam.com or Randy Schwimmer at The Lead Left, and mention that you're a friend of Fran or Dan's. We'll get you a free trial. So it's great to be with you.
Thank you, everybody. When we add up all the decades that all of us have been in this market and all that we've seen, and yet 2020, hands down, uncharted territory. So take us back there. What were your biggest fears in the height of the pandemic, as far as obviously the lending arena? And how did these actually play out? And Randy, I'd like to start with you. I know you've written some on this too. What were the biggest surprises? And then we'll go to Fran and Dan.
Sure. We are partway through the series on our 5 surprises, actually. It's, I think we're on surprise number 4 for this week of biggest surprises of 2020. But just to capsulize it into kind of the 3 big ones, I think the first was the market snapback. It's so hard to put your mind back to March of last year. But as I was prepping for this call, I went back to remind myself what the markets were doing, and particularly what the Fed was doing. And we remember, I think, March 23rd as the date when the Dow actually bottomed out. But I'd forgotten during that month that the Fed held 2 unscheduled meetings to reduce interest rates. So they did it twice, I think March 8th and March 15th or something like that. They did it twice during the month to bring essentially interest rates down to 0. And I think that's when the market started to realize, uh-oh, you know, the Fed doesn't usually have unscheduled meetings, and they definitely don't lower interest rates by, I think it was 50 basis points each time or something like that. And they basically brought it down to 0. So that was, to me, reminiscent of September of 08. For those of you who remember, that's the month when Lehman failed. It was also the month that Goldman and Morgan Stanley went to the Fed desk and said, I need money. And that was kind of that same wake-up call that said, wow, this is very different and this is serious. The Dow actually dropped in 6 weeks this past March, 11,000 points. It's just remarkable. And it bottomed out on March 23rd. Now, of course, nobody recognized the fact that that was the bottom at the time. If you started buying then, maybe you did, congratulations. But nobody really recognized that was the bottom. But that's when people started to recognize that the Fed was going to step in no matter what. They were going to flood the market with liquidity. And there began to be a pattern, which was established in the next 30, 45 days, of what was going to happen with infections and sort of shutdowns. And so the distinguishing feature that we found, both with direct lenders as well as with private equity, was a quick deep dive into their portfolios to figure out what was going to be impacted if everybody stayed at home and what was not. And I think so quick analysis and a monthly analysis of what was going on, and really trying to understand the difference between the visible shutdown and the behind the scenes activity that was going to go on no matter whether we stayed at home or not. And those are more of the business to business kinds of sectors in some forms of healthcare, not the patient visiting type, but the other types, technology, software. And so the big decision, I think, on the part of the market was there were some companies that were going to do quite well. And so that's when the market started to snap back as a whole. That's when the high yield market, as you may recall, which was bailed out essentially directly by the Fed as they started to buy paper in troubled sectors like cruise lines and airlines and so forth. And high yield had the biggest year they've ever had last year, which was, I never would have imagined that last March. And so you had these sectors that were doing well, and then the direct lenders, like Fran's and Dan's and myself, started to look at the sectors that were doing well and say, you know what, those are businesses that we can live with. And every month that went by, it got better and better. So you had the snapback, then you had the by industry surprises. So the companies that you thought would have done well in a downturn, like fitness centers, usually everybody, when they're out of work, goes to work out, right? Okay, in between interviews. But you can't go to work out when the gym's closed. So there were those kinds of surprises. And then the last thing was just the complete lack of correlation between our markets, to some extent the overall loan market, but certainly the middle market and private credit, and what else was going on in terms of infections, the economy, which, second quarter, 30% down. I mean, it was an unbelievable, fastest precipitous decline, I think, on the record books. So I think the third surprise was this lack of correlation between what was going on in our markets, which we'll talk about a little bit, and the rest of the world. So those were the three biggest surprises that we saw.
Fran, what about you? Thank you so much, Randy, for kicking us off with that look back.
Yeah, I mean, from my perspective, and I think this was the perspective of a lot of lenders in the market, I thought we were going to see a shakeout and a consolidation in the direct lending universe. Now, my prior role at Refinitiv, Ioana, you and I had been to countless conferences and roundtables, and I'll just paint a little picture for you. These large corporate lenders that had decades and decades of experience were looking at the direct lending space and saying, wow, this asset class has grown too big, too fast. They were watching LPs funneling billions of dollars a year. New entrants were popping up every other week. These new entrants had no workout capability. They had limited track records through a cycle. We were seeing BDCs pop up every other quarter. They were reaching for yield, lower middle market. They were doing second liens. They were doing mega tranches. They were all over the place, excessive hold levels. And then we started to see large cap terms permeating on illiquid credits, which is something that we'd never seen before, right? So to outsiders looking into the direct lending space, it seemed like a recipe for disaster, right? And people in the market for years were having constant conversations around, are pension funds going to be disappointed in their IRRs, and how much of this landscape is going to go away in a downturn? And, you know, Randy, you and I in 2019 had a discussion about the fact that we had seen like 10 BDCs in 2019 alone had come out and announced they were already exploring strategic alternatives. This was before COVID had hit. So it seemed like the space was just oversaturated and primed for consolidation when a downturn ultimately came. And then when March hit and COVID hit, right, we're looking at direct lending portfolios and seeing the dental management businesses, the physical therapy businesses, the restaurant companies in the portfolios with revenue going to zero. And you started to hear the stories of lenders not being able to fund their revolver draws, and private equity heads calling up originators saying, I'm not going to make P&I at March 31st. And you watch the whole BDC landscape trade down to 0.3 times book value. It seemed like we were going to see this shakeout and parts of the universe was going to be toast, right? And then within 2 short months, it was like these lenders lifted their heads up out of the rubble and everyone was lending again. Clearly, you know, folks were still dealing with some portfolio issues, but everyone was still left standing. These direct lenders didn't seem to have as many portfolio issues as folks had imagined. They found ways to be resilient, right? Small bank groups, covenants worked as advertised. The power of stable, long-term locked up capital prevented any sort of forced selling. The illiquid nature of the loans meant less NAV volatility. Clearly, a lot of these direct lenders did get PPP loans, which helped, but their businesses proved resilient, and sponsors, they stepped up and they put liquidity into these businesses, right? And direct lenders found ways to navigate and to survive. So here we are in 2021. I can't really point to too many direct lenders that have sold or that we saw a shakeout versus 2009, where we did see a lot of folks exit the asset class. So I think the BSL market was a little surprised and hugely disappointed because now they have to continue to compete against these lenders.
Thanks, Fran. Wow. Dan, over to you.
Yeah, interesting. So I think that's great context. The biggest surprise for me by far was that I didn't lose my job. And I don't mean that to sound apocalyptic. I had done a bunch of restaurant deals. I built our restaurant vertical, and in March, April, it didn't look like any of those were going to come back. And so I started wondering when I should call Randy for a job, honestly. So to be here is wonderful. And I think that's also a huge surprise, is the way the businesses have reacted that have been in the crosshairs, restaurants, gyms, any kind of travel industry. There's been so much carnage, and it's heartbreaking, but it's also nothing short of awe-inspiring how many of those businesses have reacted. And there's companies in our portfolio that they are truly inspiring, that they've been able to weather, and it's been a cooperation across the board. And they're better businesses now than they were pre-COVID, and they're going to be much better businesses on the other side of this. And that's to see the way some companies have weathered this is amazing. I would also just highlight in second quarter, we were backing the truck up for all the distressed credits we were going to be buying. It was fish in a barrel. We thought, geez, this is going to be, do we have enough capital? The opportunities are just going to pour in. And then felt like the Maytag repairman, waiting for the phone to ring. It was just one of those, like, how is this not manifesting? It's just amazing. And the fact that it really never did, aside from a few weeks where there was a sharp trade down. If you didn't catch that, there just really haven't been the kind of distressed opportunities that, to Randy's point, looking at the data and infection rates and economic data, it just never quite came through in trades. So shocking, I would say overall. I think very glad to be sitting where we are today. More fortunate than we were a year ago in terms of some of the ways people have been impacted by this. I feel luckier than ever.
Thank you, Dan. Yeah, it's just so much, upside, and so many things that, luckily did not go the way we feared in that apocalyptic, way of viewing things. So we've gone back and we've come forward. Let's talk about this year and what can we expect? What things are we looking out for? And I want to start with the macro picture. So Randy, the economy. Is the general economy, the tone, is it mirroring? Is it going to continue to mirror 2020? Or we have all this pent up consumerism, right? We're all in our homes. Is that going to drive growth this year? What do you think?
So I definitely don't want to be practicing being an economist without a license. So I consulted our chief economist, chief investment strategist at Nuveen, Brian Nick, and he's got some wonderful stuff that's public, actually. If you go on the Nuveen website, I think he's got a article that's entitled Dark Tunnel, Bright Light, or something like that. We've been in the dark tunnel, but the bright light, and he's referring to 2021 as well, the dark tunnel is kind of where we still are, right? Because the uncertainty of when the vaccines are going to be fully distributed, right? I mean, it's clear now that that's not going quite as smoothly as people had hoped for. The good news is that despite a lot of naysaying early on when people didn't even think that we would have vaccines, remember the negativity about even getting a vaccine by year end. Oh, it takes years and some vaccines, are never produced, right? So there was kind of a lowering of expectations, but we basically got 3 major vaccines done. The issue now is getting it distributed, and then you have the multiple shots, right? And so it's a little more complicated, but I think that as a result, our economist is basically saying, think about 2021 as being in 2 parts. The first half is going to be sort of a continuation of what we've been seeing, both in terms of the infection rate and so forth. But also kind of the economic malaise, right? So the first quarter probably going to be, kind of a 1% GDP up, but now I think, and so think about, I hadn't really focused on this. I mentioned that the second quarter was last year was 30% plus down. Third quarter was 30% back up, but the overall year was down 3.5%. So, but the expectation for the full year of 2021, based on most views, is over 4%, 4.1% GDP positive growth for the full year, with most of it being back-ended in the second half. So as the vaccines get fully distributed, then you start to gain in the second half more confidence that, there's no more shoes going to drop, that we're not going to have second and third waves, that businesses like restaurants and retail and more of the consumer-facing businesses are going to feel a little bit steadier. Travel, for example, people are going to be willing to go back on planes. Be an interesting question I wanted to the audience in terms of, are you, because you mentioned you feel comfortable going back to work. That was one of Lena's questions. What about getting on a plane? Do you feel like you're going to do as much travel as you want to? Or with the success of Zoom, do you feel like maybe it's a lot more effective to kind of do these things, but mix in with the in-person. And I think the second half we'll see more confidence. And so the overall tone, I think, and you'll see some pent-up consumerism. I think the Fed Chair Powell used that term as people go out and start shopping, particularly as weather gets better. So I think you'll see some of that, but certainly better second half than first.
Thanks, Randy. And we've been surveying the lenders with those same questions. So if anybody wants to see our survey results, we asked, when do you think you're going to get on a plane to, for new business? Because I think this has really affected the ability to win new business, to meet new investors, to meet new clients. How do we do that in this environment? And a lot of people said, look, if it's going to help me to, get in front of somebody, I will get on a plane, but hopefully not till, the vaccine, not till next fall. So we asked about I want to say transitioning, about your commute and working in a shared office. And it just seems like, as Randy said, with the vaccine, we're jury's still out on that. So Dan, you talked about the distressed, backing up the truck. And given what Randy has said, do you still see some yellow flags out there for recession? And also, is there going to be an opportunity maybe from a distressed point of view?
Yeah, no, it's a great question. And I'll be honest, I had a lot of conviction about that in second quarter, and again in the third quarter. Just got pushed out a quarter. It's all common, all that restructuring work, all the distressed opportunities just pushed out a quarter. People are being more cooperative. That's going to change. Behavior is going to normalize, and the banks are going to start firing their customers and pushing them into the direct lending land. And that hasn't happened. At least it's happened in a few places, but nothing like what you would expect given the amount of distress. So it's really hard to say, Ioana. I've given up on. I've decided to focus on my day job and just focus on what I can actually control rather than trying to predict what's gonna happen. I think Randy's summary was really interesting, and I agree with it. I think where it gets really interesting to me is I do think you'll have a combination of pent up demand that will fuel the economy for the second half of this year. Where I get concerned, and probably the first half of the following year, the big question is the Fed, right? The Fed is going to have to normalize its behavior at some point. And as you see that the pent-up demand comes out, there's going to be a decline on the other side. So managing that, just the pent-up demand comes roaring in, then people normalize their behavior back to 2019 levels. So that's what worries me, is where does the Fed start to normalize? And frankly, I think the big issue was in 2016, the Fed kind of blinked when it looked at raising rates. The market backed up. The market kind of spooked the Fed, and I'm not being critical. It was, I don't know whether it was the right thing to do or not, but I worry that markets, it's just going to be a really interesting dance, and it scares me a little bit, kind of the 2022 second half. Not that we'll be a straight line up from here to there, but I just do think as the Fed looks to withdraw some of the liquidity and normalize its behavior, and as we start to come off the bubble of pent up consumerism, that's where I think things get a little scary, just to be blunt.
That is my worry too. I think we all share it, right? What happens when the Fed, Fran, let me turn over to you and get your thoughts. Like we don't have a lot of volatility. The markets are not making sense. We're all worried about the Fed. What do you think could reignite volatility?
Yeah, I mean, unfortunately, Dan, I don't see any volatility coming back in the near to intermediate term under the current conditions. I've come to learn that cash is everything. And right now there's just so much cash. And unless you can get that cash to go away, it seems that we're just not going to have volatility in the near term. I think we can all recognize that there is a disconnect between the economy, underlying financial performance of some of these borrowers that have been impacted, and the fact that we continue to see the market grind tighter. I mean, I watch the secondary loan market every day, and I'm looking at the average bid on CCC rated loans that are like 10 times levered plus, and they have terrible documentation, and they're trading higher today than they were in 2018. And I just can't wrap my brain around it. I feel like folks are just looking past the current financial environment. They're looking past LTM financial performance, and they're just turning over rocks, searching for yield. I mean, the good news is that a lot of these businesses are taking advantage of it, and we're starting to see they're pushing out maturities, they're lowering their financing costs. That is going to help them withstand tougher times. And I think as earnings come out, folks are just kind of looking at forward-looking guidance, and they're looking at year-over-year improvements. And I think financials are going to continue to improve relative to where they were last year. And those companies that are struggling, they're just going to keep kicking the can down the road until things improve further later this year. And it's their turn to surf the liquidity wave and fix their broken capital structure. So I think the Fed's going to be committed to keeping rates near zero for the foreseeable future and just pumping liquidity into the system. As long as they keep doing that, the only thing that can really derail this boom is if for some reason the vaccine didn't work and most of the country got vaccinated and cases kept rising, but that's just seems unlikely to me. So if you can figure out how to make the cash go away, Ioana, I can bring volatility back for you.
I will take the cash, Fran, and you'll never see me again.
Well, I think Fran and Dan, you're both right? I think that the ideal, I would love to see the Fed get more worried, but they have sent a signal clearly that, in fact, they've redefined now on inflation what their comfort level is with the degree of inflation, and they basically said we're okay with it if it at even more than 2%, so even 3%, because you're still dealing with significant unemployment, right? And so, as far as I'm reading it, I think I agree with Fran. They're going to keep rates the way they are for the foreseeable future. Down the road, further down the road, Dan, I think maybe kind of 23, 24, when people start to think about how do we pay for all the money we borrowed, or there's pressure just on rates because you see this. I mean, you add another 1 point whatever trillion to the rescue package. I think that's when rates start to be an issue. But unfortunately we've got some pretty bullish times ahead over the next few years because of the liquidity.
One closeout. One closeout point. I just wanted to point out consensus scares me. So I just want to be clear. I read an article at the end of last year that was titled "Stock Market Prognosticators Finding It Hard to Be Bearish," and finding hard to find reasons to be bearish. And I read that and went, "Oh my God! Like that is not good." So that's not a prediction in any way whatsoever. I just think black swans emerge when things seem pretty clear, and so I'm just throwing that out there.
If we're all thinking the same way, Dan, we're not thinking, right?
And I mean, I think it's also very telling that the thing we're all talking about is the Fed and the support. I mean, that says it all right there. What about the fundamentals are not, where they need to be whatsoever. So, and Randy, you sort of took us back there in the beginning. I mean, in 2008, it took the Fed something like 8 months to do what they did this time in a matter of weeks. So this time they came out with, you could say QE1, QE2, QE3, in a matter of weeks. And it took 8 months last time around. So obviously the response was also very different. But what I want to do now is transition and drill into private credit a bit more, unless anybody wants to add anything. Randy, you want to add anything, or Fran? No, okay. Okay, so let's go to private credit. You guys are pros in this. And Fran, I want to start with you. You speak to investors in your role, and you see the investor. You guys are investors. And I want to start with relative value. So how do investors see private credit relative to all these bigger trends we've been talking about? So relative to bonds and larger liquid loans, and how will they view private credit, and how are they viewing it?
Yeah, I mean, following COVID, folks are viewing private credit very favorably, as I highlighted earlier. If you can get comfortable with giving up some liquidity, it solves a lot of issues in terms of the asset class having far less volatility in underlying asset values and much more predictability in terms of your returns. And I do think that investors are getting comfortable or more comfortable with giving up liquidity. I mean, if you just look at what happened last week in the news with hedge funds, with the whole GameStop and AMC short selling trade, I mean, that's a whole brand new risk now that an LP has to really wrap their brain around when you're allocating to hedge funds. Or Dan, as you mentioned earlier with distressed debt, right? The whole thesis around distressed debt seemed great. You thought there was going to be this wave of defaults, and those opportunities dried up pretty fast, right? How are those managers going to deploy that capital right now? I think LPs are viewing private credit right now as having a very low standard deviation of returns. It's a very steady and predictable dividend yield and IRR throughout the cycle. It's low duration, since loans are floating rate, which is very, very favorable in this environment, especially when investors are nervous about inflation over the near to intermediate term and how those rising rates are going to impact their fixed income portfolio. So I think, if you look at direct lending portfolios, they went through hell and back, and IRRs, they really didn't get hurt too much. They bounced back quite quickly within 1 to 2 quarters. And at the peak of volatility, you look at the more liquid markets, and the average bid in the syndicated market, it fell to 75 cents on the dollar. Meanwhile, the average mark on a direct lending portfolio maybe only fell to 88 to 90 cents on the dollar. And within 1 to 2 quarters, investors pretty much recouped those losses. So I think it gives investors a more stable and defensive portfolio allocation that they can count on.
I'm with you. Thank you, Fran. Now I want to talk about opportunities, right? So where will the opportunities come from? And to that, I'd like to turn to Dan and Randy. So Dan, you're in the market, you're looking for alpha, you're kind of generating outsized returns. Randy, you're the middle of the traditional middle of the fairway middle market sponsor finance. So we've got some different vantage points, but you've also sat, both of you have also sat in many different hats, sat in many different seats. Where do you see opportunities to lend to these different strategies though, moving forward? So maybe if it's might even be too simplistic, the alpha and the beta, but where do you see the opportunities, and where are you more open to doing deals?
Yeah, no, good question. So it's very akin to our golf game. Randy's in the middle of the fairway and I'm off in the woods, just looking around, turning over leaves. Dang it, where'd that thing go?
I wish that was the case.
So we play off the fairway for sure, which means, keep your 10-foot pole handy, because you find some pretty challenging situations that you want to avoid quickly. But then we break out our 5-foot pole and say, okay, let's do a little exploring here. Let's learn a little bit and see if there's some value here that others aren't seeing. So we do a lot in the world of knee-jerk no. That just so, closed a deal in the hotel services space last month. And I mean, the syndication on that was beyond challenging, because I got hung up on, when I said the industry, over and over again. So, but it's actually a really nice business, performing really well. So, but you've got to be open to hearing the story. So that's where we spend our time. I think in terms of opportunity, I'm excited about the stuff that's going to be reopening. I think lenders will be coming back to that space in 2022, 23 as they normalize. I think a lot of people will be reluctant to dip their toe in the water initially. And that's a dynamic that we like. And so, you can be very, very selective, but things in the restaurant industry, office worker focused, travel, just any business that's really struggled as they start to get back open again. Now you have to be careful about the decline on the other side of the pent up demand. So you got to underwrite it carefully, but I think that's where we see opportunity in the coming quarters.
Yeah, Dan, I think that's a perfect description of what's going on out there. And what we had, because we are a conservative shop, we turn down, I think the latest stat is like 93% of the stuff that comes in. And by the way, we have, I think about 70% of the sponsors that we're dealing with we are an LP. We're actually an investor in their funds. So we're a client of theirs, and we're still turning down 93% of the stuff they're showing us, because we have a very kind of defined view of our world. Since we're not going to get outsized returns, we're going to get that kind of 7 to 8% unlevered yield year over year. That's that classic middle market, first lien, cash flow oriented, secured, but focused on cash flows business. And the alpha that we generate is from not generating any losses, right? So if you have no losses, you're going to max on that 8% or whatever the number is. And then if you throw leverage, if you're a fund that likes to throw leverage, you can get even more. But we were so conservative that in 18 and 19, we were losing out to other lenders who were being more aggressive, not just in terms of industries and companies that they were financing, but also the amount of leverage they were putting on small companies and so forth. And we always thought, look, when the next recession comes, we're going to be like the squirrel that stored all their nuts over the winter, right? I forget how that fable goes, but we were doing that. And then we woke up in March and realized that all that work actually paid off. We had no covenant, no defaults related to COVID at all last year. And we have 150 portfolio companies, 6 billion of assets under management, senior debt. So it was because we had structured it to not do any consumer facing deals. It was all defensive, business to business kinds of companies. And even in this few situations, we actually did have I was joking about fitness centers. We actually had one fitness center that went to zero revenue, but because the sponsor put in money, they drew down under the revolvers, everybody had the liquidity, they lasted for 6 months until the things started to open up, and then they were fine. So the lesson learned was, stick to your knitting. And so there's actually no real opportunities that are different. We're actually now just the stuff that we, the way we structured everything was like, okay, we're going to be able to commit large dollars with sponsors that know us. And that turned out in 2020 to be the winning formula, because at the end of the year, and I think, Dan, you probably saw this, and Fran, you probably did too, the volume went from zero in the second quarter to like off the charts in the third and fourth quarter. We had a record fourth quarter, a record year, and a record December. I think we closed 18 deals in December. And what was weird was we were closing deals in November with a sponsor that said, oh, by the way, you're doing such a good job on this one. We have another one next week that we need to close by year end. And we're like, okay, what is it, December 3rd? I mean, how are we going to get that done? But they were so familiar with the way we work and our credit agreements. And that's half, Dan, that's half of the issue, right? If you negotiate the credit agreement and and there's a lot of time spent doing that, it's like, well, let's use the same one. And so there was the ability to commit a large amount. We can hold 150 per deal, commit 250 or whatever it is. And then have these relationships. That's the opportunity. So it's just doing what we've been doing and sticking to the sectors that we think are going to, be still in this positive zone that we're in relative to everything going on with the virus.
Thanks, Randy. And I want to talk about the froth in a second. But before we leave structures and talk about how insanely frothy they are, Randy, yes, 18 and 19 was just, I want to ask you guys this question, and then we'll kind of go into the structural erosion. But it's one that people love to ask this kind of question, would you rather, A or B? So would you rather lend to a COVID lift business with really strong financial performance, but it's got aggressive leverage structures, or a sector that went through a COVID blip and struggled, but they are more conservative? The capital structure is more conservative as a result. Anybody?
I'll take the lead. The latter by far, and that's just our strategy. That's not saying one or the other is better. It's just we tend to go where there's less competition, a lot less competition, and that means you got to be really, really careful with your diligence, and you've got to be very selective and willing, frankly, to make some tough decisions. That as you learn that it's not quite what you thought it was, and those other guys were right when they chose not to engage. But that's our core strategy, is looking for things, and we do a lot of non-sponsored deals, by the way. So you're doing all the diligence, and yes, it's by definition our strategy is to go to where others aren't, and that means we get better structures, but we're taking different risk. You got to be honest with yourself about that.
Okay, and the market, structural erosion, we have talked about it for years. It's been a part of the market. In the broadly syndicated, or as we say in the BSL market, that's been a major issue, and that continues. And we continue to see it. In fact, we're in a repricing wave right now, which I would never have thought, in the over 20 years I've been studying this market. And Fran, I want to turn it over to you and ask you, how does this impact the direct lending market?
Yeah. So the good news is that in the direct lending market, you don't see repricing waves. There's just a floor on pricing in that market. And it's not like the BSL market where you can have hot money swooping in and out, like you don't have loan mutual funds and stuff like that, where money just comes in, or crossover investors. It's a little bit more resilient. And in general, direct lending volume is 85 to 90% new money. So where you tend to see sponsors come in and reprice their deals is when they're executing maybe on a div recap, or they're doing some sort of portfolio add-on acquisition. And for really, really good credits in hot markets like this one, the direct lender is certainly going to get pressured to lower pricing down to maintain the incumbency on their deal. But in terms of the BSL repricing waves, I do think direct lenders are going to be impacted a few ways. So first, we did see in 2020, a lot of direct lenders that had cash, that had raised recent funds, were partaking in some of that distressed debt selling in the secondary market, and we're buying credits, kind of on the upswing. And a lot of those are now getting repriced. So they're going to see some cash being recycled back to them, and they're not going to re-up into those credits because they're just pricing way too low. The other thing direct lenders are dealing with right now is the second liens. That is one of the most common tranches we're seeing get repriced right now. Sponsors are even paying the heavy call protection to get these second liens repriced and just issuing heavier amounts of first lien debt at lower costs. So BDCs and direct lenders make up a very, very large share of that buyer base for second liens. So they're going to have to now find ways to redeploy that money into some sort of higher octane paper to maintain their, their dividend yields and their same return. The other one, the big one, is the Uni Tranches. So, we saw in 2018 and 2019, we were seeing these mega tranches where sponsors were just bypassing the syndicated market and doing these large billion-dollar unis. And those are kind of out of favor right now. We're not really seeing too many of those because they're already back to pricing of 550, 575, which is kind of a floor on those types of unis. And that's still very expensive relative to what you could do a first lien, second lien deal right now in the BSL market. So all of those factors are going to impact the direct lending market. It's going to make it more competitive. Direct lenders are looking at raising another 100 billion in capital this year. So I think what you're going to see is pricing's coming down now. Pricing tends to go first. And then once it hits a floor, folks start to compete on docs and covenants like 2018, 2019. And we're already hearing about, direct lenders back to pitching Cov Light unis. So I think we're back. We're kind of back to pre-COVID. It's coming.
We're back to the future.
Back to the future.
So let's talk about in our last section here for the audience, just to keep you all, we're looking at time, we're cognizant of time. We want to talk about the outlook for direct lending, the future of direct lending. And I guess to do that, the first question is maybe to Randy and Dan, are we in a new business cycle? So as you look at these issuers that you want to invest in, was 2Q 2020, was it just a blip and we're still recovering, or are we in this new business cycle?
Yeah, that was the question. I think we were posing to each other, right? Because we didn't necessarily have an answer. And you could make a case for either one. I think we're probably in a different cycle just because the intensity of this COVID wave on everything just creates a very different feel than it was. It's not like that's going to go away. We're going to shut the door. I mean, I'm already hearing people worried that, yes, the vaccine may work on this variety, but just like flu shots don't work, right? They're like, I think 50% effective or something like that. I mean, maybe the vaccines are going to be okay for some, but not for others. So I think we're still going to have this residue. I think people will still be nervous about some consumer-facing businesses that will not go back to the, where we were. But my sense is I agree with Fran, from a credit perspective, we're back to, compressing spreads and higher leverage. So from a credit cycle, which is really at the end of the day, kind of where we live, I think that we're back kind of where we were in 18, 19, with the one difference though, that purchase price multiples for the good businesses are higher, and therefore for senior lenders, and I guess to some extent for junior as well, the loan to value is a lot better. I mean, we're at 40% loan to value consistently now, pretty much, which is below where we were in 18-19. So that's one positive.
Thanks, Randy. And, you know, this way the audience, I guess, got a glimpse of what kind of things we are all asking and talking to each other about, because especially in the seats that you all are in, these are the kind of things that you're kind of informing yourselves, because the issuers are giving you certain stories and you've got to evaluate, you know, what's the right investment here? What's the right decision? I think that kind of question really plays into it, because some companies will be affected very differently, whether you have a view that we are in a new cycle or whether you have the view that it's the same old credit problems, you know, from 2 years ago. So I think these are the kinds of things that, you know, you all are asking as you look at these credits. And just cognizant of time, really want to talk about the lenders now. So we've talked about the credit and the fundamentals and the economic outlook and structures on the loans and BSL versus middle market. And Fran, you talked about it. Let's start with you about, you know, this year in fundraising, and we track fundraising numbers too, and it was a huge year. We expect another big year. So are we primed for another round of this growth that Fran described so beautifully a couple of times, this accelerated growth? And if so, what about the new entrants coming in now? Is there a higher bar? Is the bar set higher for them?
And Ioana, I'm quoting your fundraising figures actually. So you guys do a great job. You guys do a great job of tracking them. So I do think, you know, direct lending is going to continue to grow. It's going to continue to take market share. But I think in the prior cycle, it was going like this, and I think it's going to moderate a little bit. So this is where I see a lot of growth coming in that's new, you know, first from the retail channel, that's getting more and more exposure to direct lending through new products. I think retail investors are very yield starved. They don't have as many attractive alternatives to some pension funds and qualified investors. So I see money coming in from that segment. And secondly, I think foreign investors, European investors are looking for very tax efficient vehicles, and they just don't have the same yield and interest rate opportunities in their continent that we have. So I do see money continuing to come in from those areas. In terms of the domestic pension funds and the big institutional players in the US, they're already big believers in direct lending. They've already committed. They may increase their allocations somewhat post-COVID, but I don't think you're going to see a sea change from those investors. Some of them may shuffle the deck a little bit and change up their manager selection and try a few new ones. But if their managers did good in the last cycle, they're probably going to stick with them, especially like the big brand names that performed really well. They may be more interested in some differentiated strategies around the edges within private credit, but I don't see them really changing too drastically. And what also is interesting for the pension funds in terms of private credit is they're so sophisticated now that they're actually looking for more creative ways to get involved in direct lending. So whether it's joint ventures or co-investment portfolios or SMAs, they want to drive their fees down and they want to have more control. So it's a little bit different than the last cycle where they were piling into these commingled funds. Just in terms of new entrants, you're right, like from 2012 to 2017, we saw a flood of new entrants, but beginning in 2018 and 2019, I will tell you, it got harder, right? The market became more saturated and you just had too many lenders that kind of do the same thing, middle market, sponsored finance, backed by top tier private equity shops and defensive sectors, right? That's like everyone's pitch book. And some players at this point have just so much scale and so much market share that I just think in this next cycle, the bar is a lot higher. So I think it's going to be much harder now to see new entrants come in, especially if they have a limited track record and they don't have a differentiated strategy. But overall, I think we're going to still continue to see the growth. I think it will moderate a little bit.
Thanks, Fran. And Dan, maybe I'll turn it to you. How do you see the lender landscape, the direct lender landscape evolving? How do you know? And if you have anything to add on new entrants, I remember with the specialty finance companies that came up in the early 2000s and started to compete with the banks, or they would do deals that banks weren't doing. And we had that whole kind of universe of specialty finance companies that came in. Eventually, it was really hard for new entrants because these existing guys had origination platforms, they had relationships, and for somebody new to come in and try to prove to themselves, it was a real challenge. So what's your view on the direct lending landscape, Dan?
I think Fran said it well. I think that it's surprising that she talked earlier about how it looked like so many platforms were going to have to consolidate / liquidate in the second quarter or third quarter of last year. Didn't happen. I think it's going to be very tough for new guys to come into the market. I think you're going to see the existing guys grow. I think Fran's right on that. I think that's really, and frankly, Fran and Ran are both better positioned on this question because they really have their finger on the pulse. I'm off in the woods, remember?
Randy, anything you want to add?
Yeah, I think the lesson that is going to be learned is that you have the three cases for your models that you run for the deals. You have the sponsor case, you've got the base case, and you've got the downside case. We learned last year that there's a fourth case. It's the no revenue case, okay? And that's the one that you have to run to sort of see, okay, what if we have a shutdown, for whatever reason, what happens to this business? And the corollary to that is if you offer a revolver to a sponsor and a client, they will draw it fully drawn when they need it. So just expect it because it will happen. And we learned that back in 08, 09, but it is a truism. So those are the two lessons we learned.
And I'm cognizant of time. We just have about a minute left here, and I didn't see any questions come in. So I may just turn it over to Dan and Fran. I mean, yes, I tripped myself up, you guys. If anything else on the lessons front, I mean, I think Randy answered it beautifully and simply as to what might a direct lender, do differently and have to tackle next time, and what do we learn from this? And to anybody, any parting comments, lessons, or otherwise before we wrap up the panel?
So I would just say that my lesson learned through the pandemic, and it really go back to pre-pandemic, it's know and stick to your strategy. And I mean, and just, in good times and bad. That's what we have LPs and leverage providers telling us is our portfolio held up relatively well. We have our challenges, don't get me wrong, but on a relative basis, it held up because we were less frothy. We tended to stick to our knitting and frankly lost a lot of deals. And I spent 18 and 19 trying to convince my partners we should be doing those deals. And when I brought them to them, they keep saying, no, bad Dan, stop doing that. And I was very frustrated at the time. I am extremely happy that they did that they held the line. And that's not a GameStop reference, by the way, just to be clear. I don't want to confuse things. But I think just generally, the last thing I'll say is through the darkest days, as things got darker for me, it was more important than ever to just punch in every day and do the work and just kind of continue and rely on the incredible team that we've built. I'm very fortunate to have them, and they protected me from myself, my worst instincts, which I appreciate.
Dan, thank you for rounding that out. And it reminds me of, Randy, some of the comments you made about sticking to your strategy consistently. And that's obviously what the strategy you're selling to your investors. So you're doing right by them too. And Dan, I want to thank you and Comvest for sponsoring this, and Lena and Opus Connect for hosting us and allowing us to have this discussion together. If you couldn't tell, we have a lot of fun up here. And Lena, I'll turn it over to you.
Yes, thank you so much. Dan, Fran, and Ran, appreciate your contributions. And Ioana, thank you for leading the way. I think that was a very insightful discussion, and looking forward to getting that up on our YouTube soon. So stay tuned for more info on that. We have an upcoming webinar. We're doing a food summit paired with a Deal Connect. So that's on the 24th of February. For those of you who are participating in our Deal Connect meetings after this, you're going to want to log out of this link and log into the separate link that my colleague Terrence circulated earlier. Again, thank you to our panelists, our sponsors, and of course, our attendees. Stay well, and we'll see you all soon. Thanks, everyone.
Hey guys.